right, let's take a look at the bigger picture and continue talking markets with Ed Siddell, CEO and Chief Investment Advisor at EGSI Financial. Ed, thanks so much for joining the show. Great to see you.
Yeah, thanks for having me.
All right, what do you think the biggest driver of the rally that we've seen this week has been? I mean, this is the best week of 2023 so far?
By far. And I think it started with Powell in his speech on Wednesday, kind of alluding to that they were going to hold fast and not raise rates. And then it kind of went forward to the jobs numbers that came out today. You know, that bad news is good news, at least for the markets. And then we saw bond yields fall, a little over 0.5% today so far. And, the markets really like that because they're anticipating, a soft landing. So I'm not sure if that's accurate or not, but at least that's how the markets are reading it.
Is cheering a softening labor market, is it actually a good thing? I mean, we know it's what the Fed wants to slow inflation. We know this market kind of likes bad news is good news. But should we be cheering a softening labor market?
Well, you know what? Actually, let's go back and look at what happened, 8 out of the last 9 months, because 8 out of the last 9 months, they've revised those jobs numbers downwards. And I wouldn't be surprised if they do it again for this month as well. So the economy is not thriving and as strong as everyone purports it to be, in my opinion. And really, the reason is that the growth of the economy, if you look at over the last 12 months, we've hit 1.3 trillion plus in credit card debt, with a 50% increase in credit card debt just over the last 12 months, while savings at the same time is coming down. So, the growth of the economy is being built on more debt. So that does not allude to a strong economy. And I don't think we should be cheering a slow economy right now, because inflation is still strong. I think it's going to be around for a long time. And the Feds have really been letting the markets determine interest rates. And that's why they're still hovering around 8%.
Do you think we've seen the peak in bond yields?
Honestly, I don't. Maybe for this year, but I think it's going to be short-lived going into next year. I mean, we're facing a debt crisis. Just not just consumer debt. We've got defaults on car loans at highs, increased bankruptcies both on the consumer level as well as business level. And the amount of spending, we're continuing to spend and spend and spend, not to mention the national debt. So we're approaching, $34 trillion. So until we get spending under control, and I think inflation is still going to be here, and I would not be surprised if, towards the end of the first quarter, we see bond yields go up again.
So I guess it's no surprise that when I'm taking a look at the notes, you're pretty cautious when it comes to your portfolio positioning, talking about gold and commodities and short-term investments that yield 5%. What do you need to see to be more bullish or less cautious or defensive, if you will?
Just be patient. We've got an awful lot of earnings coming out next week, depending on what the Feds do in their meeting in December. But still, there's opportunities out there. And anytime you have a market like this that's very volatile, a lot of ups and downs, a lot of mixed messaging when it comes to economic news and jobs numbers, it does provide opportunities. So finding those companies, those value companies that are involved in commodities, like Exxon, that provide good dividends, have strong balance sheets, a lot of cash on hand. Those are the opportunities right now. But I think being patient over the next couple of weeks through the end of the year is going to be really important, because if you have enough cash on hand, you're going to be able to take advantage of some really good deals going forward.
So, Ed, between now and year end, do you think this market moves higher or lower from here?
Again, I think it's going to depend on next week. We've got an awful lot of earnings coming out next week, depending again on the Feds and what they actually anticipate, because during Powell's speech on Wednesday, he basically said, throw away the script. We're really not looking at the dot plot. Each meeting we're going to determine if rates are going to stay the same, if we're going to raise them or lower them, because typically, it's 4 meetings after they stop raising rates that they start to lower. But he basically said, let's just go ahead and throw that script away. We're just going to have to play it by ear. So, just taking it one step at a time. And I think December is going to determine if we really do have a Santa rally.
All right, we'll have to wait and see. Not too far away. Ed Siddell, EGSI Financial, thank you so much.
Absolutely. Thank you.